What if everything we've been told about the AI revolution is missing a critical warning sign? What if we're watching history repeat itself, but this time under a different name? Today, AI isn't just shaping technology, it's transforming economies. But at what cost? Some call it innovation. Others fear it's a full-blown bubble waiting to pop. So which one is it? Let's start with the basics. Massive amounts of capital are flooding into AI. Behemoths like Nvidia, Tesla, and Palantir are grabbing headlines and investor cash. But behind the hype, sobering statistic. Over 95% of companies have yet to successfully implement AI in a way that materially boosts returns. It's according to a recent report by MIT. So the real question becomes, is this a legitimate technological boom or a classic asset bubble fueled by media hype and speculative momentum? Stick with us, because by the end of this video, we'll look into the 3 strongest signs of bubble behavior. Compare it with history's biggest financial collapses. And most importantly, ask the question the markets refuse to. How close are we to a bursting point? And by the way, do you think the AI bubble has already formed? Drop a simple yes or no in the comments section. Your response matters more than you think. The resurgence of AI bubble talk isn't random. It all reignited recently when Sam Altman, one of the most high-profile figures in the AI space, made a comment comparing today's excitement to that of the 1990s. But here's the catch. He didn't specify whether it's the long build-up phase spanning that entire decade, or the final blow-off top that occurred in 1999. That's a huge difference. One implies room for growth. The other screams imminent collapse. Meanwhile, real-world analysis from the tech and academic community, including the MIT report we mentioned earlier, points to a sharp disconnect between capital invested and actual productivity gains. Yes, many people use AI tools for everyday tasks, like drafting emails, generating summaries, or doing basic analysis. But when it comes to complex enterprise demands like client management or long-term reporting, over 90% of those tasks are still being handled by humans. In other words, AI is prevalent but not yet powerful at the level needed to justify current stock valuations. In some industries, stringent corporate confidentiality rules are limiting AI deployment altogether. For example, if companies fear their proprietary data might become training fodder for tools like ChatGPT. Here's the nuance we need to understand. There isn't a technology bubble. The science and innovation at the core of AI are real. What we're seeing instead is a valuation bubble, a pricing distortion that often happens when investors project years of future returns too quickly into the present. Think about it like the internet boom in the late 90s. The tech was real, the valuations. Those climbed too fast before the revenue followed. When reality failed to meet those lofty expectations, the correction was brutal. Let's test for bubble behavior by looking at 3 key traits. First, trading volume. Right now, volume is rising, but it's still lower than the allout mania we saw in 2021. Second, supply spikes. In previous bubbles like NFTs or dot-com stocks, we saw a massive surge of new market entrants that created oversaturation. In the case of AI, capital spending is still primarily centralized among a few major players. We're not yet seeing dozens of AI companies springing up in every direction. And third, price momentum. During the dot-com era, the Nasdaq tripled in under 2 years. So far, AI stocks are up around 50 to 60% this year. That's strong, but not yet parabolic. Now here's where things get tricky. Narratives drive markets. And AI has a powerful one. It feels inevitable. It's everyone from small business owners to major enterprises is experimenting with AI, according to the U.S. Census Bureau. AI adoption currently sits at around 9.2%. But the curve, it's accelerating. This enthusiasm trickles into investment models. Buyers are pricing in not just growth, but breakneck acceleration over the next few quarters. So as long as adoption keeps climbing, the bubble, if it is one, can be sustained a while longer. But if growth plateaus or slows, that's when investors could begin rapidly dialing back their expectations, leading to a steep repricing of stock valuations. When bubbles form, liquidity is always part of the story. Right now, global central banks are in easing mode. In fact, over 60 rate cuts have been implemented worldwide in just the first half of 2025. That's the second highest number since the pandemic crash in 2020. More importantly, major institutions like the U.S. Federal Reserve are signaling further cuts to come. This flood of cheap money provides fuel for risk assets, and in today's cycle, AI is the hottest story of them all. So, the takeaway. As long as liquidity remains abundant, there's little to stop capital from chasing the AI narrative higher. Let's zoom in on perhaps the most telling indicator: momentum. Back in the late 90s, as the dot-com bubble peaked, moving averages for tech-heavy indices like the NASDAQ 100 all pointed upward. Price stayed above those lines for months. The moment that momentum faltered, the collapse came fast. Today we're facing something similar. The technology sector in the U.S. remains firmly in uptrend territory. Major AI-related stocks are trading well above their key support levels. Earlier this year, we did see a brief dip, but the recovery was swift, largely fueled by renewed optimism in real-world AI applications. At Epoch Report, we currently have a short-term cautionary stance. We even placed a small counter-trend trade on the NASDAQ 100, anticipating a healthy market pullback. But long-term, we still believe AI has room to rise, and that any dip is a potential opportunity. As George Soros once put it, "When I see a bubble forming, I rush in to buy," adding fuel to the fire. There's another layer to this, perhaps even more impactful than immediate market action. We're talking about structural shifts in labor and productivity. As AI scales, we may not see more jobs created. Rather, we're seeing work compressed. Output is rising, but with fewer hours and fewer people. That's not a short-term aberration. It's a feature of this phase in technological development. Some economists call it robot-assisted self-employment. Individuals leveraging AI tools as team members rather than fixed employees. Early on, this dynamic favors large corporations and wealthy entities with access to proprietary infrastructure. But given the speed of digital democratization, many expect this technology to trickle down to smaller entities rapidly. The transition period's still uncertain, but likely shorter than we think. Let's turn to what could be a real early warning sign: credit spreads. According to Bank of America's chief strategist, the true test of whether this AI-driven bull market will endure lies not in valuations, but in credit metrics. Specifically, the spread between tech company debt and U.S. Treasuries. As long as that gap stays narrow or stable, the market can stay buoyed. But once it begins to widen, that's when alarm bells go off. Why? Because it suggests that underlying capital costs are rising, and that the market's confidence in tech companies' ability to deliver on AI promises is eroding. Morgan Stanley estimates that capital expenditure in AI-related ventures could hit $2.9 trillion by 2028. That's a staggering number. And if that spending turns out to chase unprofitable business models, the consequences could echo 1999 all over again. Despite the warning signs, investor sentiment remains almost euphoric. According to recent surveys, 60% of investors currently believe the economy is in a Goldilocks phase. Not too hot, not too cold. Almost no retail investors expect deflation. There's a reason for that. Today's retail investors grew up in the longest bull market in history. Many have never experienced a true crash. Their instinct isn't to exit on weakness, it's to buy the dip. And their collective presence in the market is growing. Today, equities account for 36% of all U.S. household financial assets, the highest since the 1950s. But here's the trap. With higher exposure comes higher volatility. Should the tide turn, the pain will be felt faster and deeper than before. So where does that leave us? Let's be clear. AI as a technology is not a bubble. Its potential is real. Its applications are spreading. But AI as a trade, as a speculative investment vehicle, is showing classic signs of overheating. Right now, we're not looking at a 2000-style collapse. Not yet. Metrics like stock breadth, capital dispersion, and earnings support suggest we're likely on the edge of a normal 3 to 4 year inventory cycle correction, rather than systemic failure. But that doesn't mean investors shouldn't proceed with caution. Overvalued markets always correct eventually. The key isn't to avoid risk, it's to manage it. Position carefully, monitor earnings. Watch for momentum shifts, and above all, stay informed. You're still watching, you're not here for headlines, you're here for insight. So make sure you're subscribed and turn on the notification bell. Okay, because at Epoch Report, we bring you the patterns behind the noise and help you recognize the early signs of economic transition that most overlook. Now it's your turn. Do you believe the AI bubble is real, or is the fear misplaced? Yes or no? Let us know in the comments. I read every single one. If this video brought you value, don't just like, subscribe and hit that bell. Timing matters more than ever. In just 10 minutes a day with Epoch Report, you'll stay a step ahead of the markets and know when history starts to rhyme again. We'll see you in the next video. Stay sharp.